What is staking? I think that's always one of the very first questions. And people always say, hey, isn't this like cloud mining? How can this not be a scam? Where does the percentage come from? Let me know some other questions in the chat that you might have around staking. And I know for many of you, this is probably going to be super basic, but if you are in one of our chat groups on Telegram or in our social media, you know that these questions constantly come up. And so I want to kind of cover those and talk a bit about those things. At the end of the day, right, we always need to ask ourselves, how is consensus being created in a system? So basically, how do we create what's happening and what's not happening? How much money do you have in your account? Who sent money to whom? How is this consensus being created? And obviously, if we have a centralized system, well, we have whoever is in charge. So let's say you have one person, and that person is in charge and says, yep, you got money, you didn't get the money, you're not allowed to send it, you're not allowed to have access, you have access. It's basically a traditional finance system. And this is the stuff that we don't want to have. So what we obviously want to have is, we want to have this decentralized system. And so now, when we have a decentralized system, there always has to be some kind of cost. There has to be something, right? And this doesn't always have to be a financial cost, but there has to be some kind of cost to have like a vote, if you want to call it, right? And there's different ways to do this. There's very, very innovative ways that are being proposed in how to do this in a decentralized system. But so the oldest and the most traditional system is that what we call proof of work. And this is what we all know as mining. This is what we know from Bitcoin. And this is what basically we've been using now for close to 11 years. And it's very, very successful. At the moment, it is the predominant tool how to create a cost to have a decentralized consensus mechanism. And basically, what you do in proof of work mining is you have all these transactions, and let's call them little puzzle pieces. And you have all these little transactions. And instead of only having these transactions as puzzle pieces, and then basically you just checking the transactions and checking, hey, is everything correct? You have to put these puzzle pieces into a block. And here's where the tricky part is. You need to kind of guess, and it's a pure guessing game, and that guessing game costs a lot of electricity and thereby costs a lot of money. You have to guess this one puzzle piece, and this puzzle piece is what we call a nonce, a number used once. And so that's basically how this entire proof of work works, because you know, well, if anyone can guess this nonce here, it can only be done by guessing, and it's basically reversing a SHA-256 algorithm. Only done by guessing, you know that whoever kind of creates this block has done work. And this means it cannot be done for free. And so this is how all, basically, in this case, it's very stable, it's super solid. We know that cheating here is very, very difficult, even for governments. It's going to be very, very difficult to kind of cheat here or do something. But so obviously, we also know some of the downsides. It would be great to have a system where you don't need to burn electricity, right? So it would be awesome. And so a lot of systems have been proposed or looked into. And basically, one of the systems is, well, instead of buying electricity, we could lock up money or deposit money, and we would have proof of stake. And then we have this staking mechanism. In this kind of staking mechanism, what happens is you don't have to calculate this nonce. So you can put these puzzle pieces together, but you don't need to calculate the nonce. What you need to do is you need to prove that you have been depositing money. So you're not proving that you have done work. Work basically means finding the nonce. It means that you have deposited money. Now in mining, you get a return on your mining. So you get a return here. So for example, you buy mining equipment and then you get a return. In staking, the exact same thing happens. Just instead of buying mining equipment, you get your return based on the money that you deposited. And here's the same thing. Basically, the percentage is inflation. This is really important to understand. It's always inflation. So this is not money that is like coming out of whatever, that's coming out of a scam. It's pure inflation in the system. For example, in Bitcoin, inflation is 12.5 Bitcoin every 10 minutes or every block. And in all the coins, for example, you look at the coins that we are listing on Cake and many, many, many coins, what's happening is you have this kind of inflation. Now here, basically then what happens is, these coins ask you to create kind of masternodes. And masternodes means it's not that everyone just can put any kind of amount in, it's you need to have certain kind of minimums. So for example, you need to have at least 1,000 coins, or you need to have 5,000 coins, and so on. And this is how these masternodes mostly work when, and this is important, when we're talking about a consensus algorithm. Now, in this case, and I'm going to use this example, and I'm going to talk, for example, like coins like Dash or also PIVX and many other coins. They don't necessarily work this way, they work in a different way, and I'm going to explain this to you. So in this kind of case, these whoever masternodes can be part of the consensus algorithm. And it's not possible for everyone to participate in this, because just make an example. Imagine one of these coins is $10 per coin. So this would mean you need $10,000 in this coin to participate and to actually have access to this percentage, right? So it's a very simple way. And so the same as you have mining pools to help here, you have so-called staking pools here. And so basically what these staking pools are doing, for example at Cake, we pool people's money. Now all these people could stake themselves, so it's not that they necessarily need Cake, but they need technical skills, they need to have service, and they need to have enough money to actually do this. And then they can stake. So in this case, Cake pools the money, and that's why the service is called Pool by Cake. It pools people's money and then stakes it. These coins pay a return to Cake. Cake takes out a small profit. It's really tiny. You can see the profits in our Q&A. It's basically $10 in total per node per month, plus a small fee on top, and then pays the reward to everyone back. And that's how everyone wins. These people, you as users, you couldn't stake yourself, and the coins benefit because they have more and more nodes. And obviously for Cake as a company, we make a small cut on these rewards, but pass the large majority on to the users. Now, this is basically the first version how to do this with so-called masternodes that are part of consensus algorithm. But then there's other masternodes. So for example, Dash. If you are staking in Dash, you're actually not participating in the consensus algorithm because Dash uses proof of work for a consensus algorithm. So what is the staking doing there? Well, staking can work in a second way. So on the one hand, we have these so-called masternodes for a consensus algorithm, but there's also a second way, and this is for privacy features. And actually a lot of the coins right now are using this, and most of the coins that we, for example, stake right now on Pool actually do this. Basically how it works there is, imagine it this way. Imagine here's person A, and they want to send a transaction to person B. Now, if this transaction is direct, everyone knows A sent to B. But so imagine there's a large swimming pool here in the middle, right? And this is a pool. And imagine person A wants to give a cup of water to person B, but it doesn't want anyone from the outside to see that A gave it to B. So what A could do is, instead of passing B the water, it could pour the water into here, and B is allowed to take it out of the pool. So what it needs is, it needs a lot of water, and in this case, water is coins. It needs coins in there where this mixing can happen. And basically, this is what's happening, for example, here at Dash, and this is how the privacy features work, and this is where the masternodes are used there. And obviously, for this service that you provide, this liquidity here, this is where rewards are being paid out to the stakers. Dash is a very good example in this case, because Dash you need to have, for example, 1,000 coins. And so at the moment, Dash is approximately $100 each. So one node costs you around 100K. So it's very, very difficult for the individual to have 100K and participate from that. But if you're pooling it together, then it gets very, very simple and very, very easy. And so that is pretty much a very simple overview of what staking is. It is a super simple overview and explanation on that this is definitely not a scam, because this money just comes from the consensus. And just like in mining, these coins come out of the consensus. In this case, they come as well. So the percentage comes from there. The big difference in cloud mining, this is really important. In my opinion, most cloud mining is a scam, so be really, really careful, because the margins are not there, right? So here the margins in the mining stuff is not there. But staking is very, very difficult because it does not have anything to do with mining. And I hope that kind of answers all those questions. What staking is, how does it work, how does it compare to proof of work, where is actually the money coming from, where those percentages coming from, and it kind of walks you through all those things here in step by step here.